Alright, quick breakdown. What's happening with the S&P 500 right now? On Monday, the S&P 500 slipped from recent record highs. It lost ground, down about 0.3%. The Dow closed lower, down about 0.2%. The Nasdaq slid, about 0.4%. So why the sudden slide? It all points to the Federal Reserve. Traders are on edge, waiting for the Fed's decision. The central bank meets this week. Will they keep rates steady, or will they hike again? Most analysts expect a hold. Inflation has cooled a bit. The economy is still chugging, but investors care as much about Fed comments as actions. Will Powell hint at future cuts, or warn rates stay higher for longer? Those clues can move markets in minutes. The S&P had a strong run, record highs last week. With Fed uncertainty, traders pull back. They lock in profits, they wait for clarity. It's not just the Fed. Oil prices are climbing. Big corporate earnings are coming. That adds unpredictability. What does this mean for investors and watchers? Short term, expect choppiness. Markets get jumpy before Fed statements. Fundamentals haven't shifted overnight. The US economy is still growing. Unemployment is low. Companies are posting solid results. Quick takeaway, don't be spooked by one day. Market reacting to uncertainty, not disaster. After the Fed decision and Powell's comments, traders should calm down until the next headline. Watch the Fed announcement this week. Long-term investors, take note. Market-curious viewers, stay tuned. If this helped, hit like and subscribe. Thanks for tuning in. Analysts are parsing Fed signals, focusing on policy guidance and economic data. Key takeaways: don't panic, watch Fed comments, fundamentals remain strong. Fed policy works through rates, credit, and expectations. Investors, from young professionals to retirees, are monitoring developments closely. History shows markets bounce back after rate cycle volatility. Financial planners recommend patience over reaction. Diversification and risk management help weather uncertainty. Measured, calm responses often outperform emotional trading. Dollar-cost averaging smooths entry over time. Advisors discuss how policy affects savings and allocations. Positive indicators include jobs, consumer spending, and investment. Match strategy to your time horizon, short, medium, or long-term. Retirement plans should factor in policy shifts, not panic. An emergency fund provides a buffer during market swings. Long-term charts show resilience through past Fed cycles. Executives adjust plans based on anticipated rate moves. Different sectors react differently to Fed decisions. Interest rate sensitivity varies across asset types. Small businesses evaluate financing and cash flow options. Mortgage rates often track Fed policy expectations. Real estate pros weigh rates when assessing demand. That's the takeaway. Stay informed, stay diversified. If this helped, hit subscribe and turn on notifications. Join a community of informed investors for ongoing updates. Next up, we'll dive into sector impacts after the Fed decision. Thanks for watching. See you in the next update.